Good evening. Welcome to Doc's Market Minute for Wednesday, the 28th of October. This is the S&P 500. I thought I'd spend a couple of minutes to walk you through what's going on since everybody seems to be losing their collective minds today in panic. All right, so from the early September highs on the S&P, we corrected down in a very mild correction, then rallied back up almost to new highs. And then we flagged out from that point. Now, what's happened in the last 3 days is that we've had two 90% down days where 90% of the issues in the S&P 500 are down. Right now, with about 5 minutes left to go in the trading day, we are down 465 advancers are actually declining. So we only have 35 advancers, 469 now as I speak, decliners. So super bearish day, easy to overreact and panic at this point. But what I want to show you is what's actually happening on the chart. So one of the things that we've done on a positive note has been to clear all these gaps that we've had. So we had some massive gaps setting up over the last few weeks to the upside. You can see that all of these gaps have now been cleared. And it's not that all gaps have to be filled, but it really does help when there is no leadership in the market. And clearly there is no leadership right now due to all the uncertainty, not only with the election, but also the second round of the virus. But oh, by the way, everybody knew that back in the spring that we were going to have a second round of this. So to me, this is just a convenient way to take profits prior to the uncertainty of the election. Now, what we're seeing here is that today alone, we gapped down and we blew through the 61.8% retracement of this swing. So this swing from bottom to top, this is the 61.8% retracement of this. And typically when the price goes through the 61.8, we tend to fill in the entire triangle. And it got a real good head start on doing that today. When I'm talking about the triangle is this move here. So the probabilities have now improved that we're going to revisit at least 3,200. Now, what I want you to watch in the next few days is whether or not we actually undercut 3,200 or print a higher low. If we print a higher low, if we stop short of creating new lows down here, just above 3,200, then this is nothing more than a great big wide consolidation. So let's move this out to the weekly chart. We can see this a little bit better. Range expansion goes to range contraction. This is a higher low, lower high. And if this prints another higher low, then that's going to be significant if it rallies from there, because what that's showing is that this is just a big consolidation. However, if this actually undercuts the low, and if we start to take out some of the important fibs there too, then this could be in a hurry to the downside. This could be in a hurry to the downside. So we'll draw this on the weekly chart now, the entire swing. You can see that the price is approaching that 23.6 retracement. What we have to watch for is this level right around here at the 38.2 retracement and around the 3,100 level. This level needs to hold if the market's going to stay steady. So that's one level to watch, is that 38.2 retracement on the weekly chart. What I also want to see hold, if the market's going to be positive going forward, is this 200-day moving average. So this 200-day moving average should come into play here fairly soon if we do undercut 3,200 and get down to there. How the price treats 3,200 will be important. Notice what happened way back here, right? What happened back here? It blew through it like it didn't even exist, rallied back up, retested from below, and then said goodnight. So watch how the price moves. This move here is very, very different from the character of this move here. All right, guys, that is it for today's Market Minute. Thanks for listening, and we'll see you in the next one.